Nobody told you the price of the American dream, not the monthly payment, not the down payment, the real price, the interest you will pay over 30 years, Nick or Stott or Sniper, the real price, the property taxes that never stop, the maintenance costs nobody mentions at the closing table, the transaction fees when you sell, the opportunity cost of everything that capital could have become if it had been deployed differently. When you add all of it together, when you do the math that the mortgage industry, the real estate industry, and the government all have a financial interest in you never doing, the number is staggering. And the story they told you to make sure you never asked for that number is one of the most successful pieces of financial mythology ever constructed. Your house is not an investment. For most working class families, it is the single most expensive purchase of their lives, sold to them as wealth building while quietly transferring that wealth somewhere else entirely. This video is about where it went and what you can do instead. In 1934, the United States federal government did something that changed the financial lives of every working class family in America, and almost none of them understood what had actually happened. The National Housing Act created the Federal Housing Administration. The FHA introduced the 30-year mortgage. Before this moment, if you wanted to buy a home, you needed roughly 50% of the purchase price as a down payment, and you had to repay the loan within 5 years. Homeownership was genuinely difficult. It required real capital. It was by necessity, reserved for people who had already accumulated some wealth. The 30-year mortgage changed everything. Suddenly, almost anyone could buy a home. The monthly payments were low enough to feel manageable. The barrier to entry dropped dramatically, and across the next several decades, home ownership rates in America climbed from around 40% to nearly 70%. This was presented as one of the great democratic achievements of the 20th century. The American dream made accessible to ordinary people. A nation of homeowners. What it actually was, what the data has been showing for decades but almost nobody wants to say out loud, was the largest transfer of working-class wealth to financial institutions in the history of the modern economy. And it was sold to you as the smartest thing you could ever do with your money. Let us start with the mathematics that your mortgage lender does not show you on the day you sign. You buy a house for $300,000. You put 20% down, $60,000, which is itself a significant portion of most working-class families' savings. You take out a mortgage for $240,000 at a 6% interest rate over 30 years. Your monthly payment is approximately $1,439. Over 30 years, you will make 360 payments. Total amount paid, $518,000. You borrowed $240,000. You will pay back $518,000. The difference, $278,000, goes entirely to the bank in interest. You will pay more in interest than you paid for the house itself. But wait, the house will be worth more in 30 years. Property appreciates. That is the whole point. Yes, and here is what nobody tells you about that appreciation. The average annual appreciation of residential real estate in the United States, adjusted for inflation, is approximately 0.2% per year. This is not a controversial finding. It is the conclusion of Robert Shiller, the Nobel Prize-winning economist who has tracked American home prices since the 1890s. In real terms, in actual purchasing power, homes barely appreciate at all over long periods of time. The number goes up nominally, but so does everything else. When you adjust for inflation, the house you bought 30 years ago is worth almost exactly what you paid for it in real terms. You have not made money. You have kept pace with inflation while paying $278,000 in interest to a bank for the privilege. Here is where the myth gets more sophisticated. You would have had to pay rent anyway. At least with a mortgage, you are building equity. The rent is just money you throw away. This argument sounds reasonable. It has been repeated so many times by so many real estate agents and financial advisors and well-meaning parents that most people have never stopped to examine whether it is actually true. It is not. The concept of rent as throwing money away only works if you ignore everything you spend on homeownership that is not building equity. And that list is long. Property taxes, in most American cities, between 1 and 2% of the home's value every year. On a $300,000 home, that is $3,000 to $6,000 annually. money that goes entirely to the government and builds you no equity. Maintenance and repairs, 1 to 2% of the home's value per year. A new roof, a furnace, plumbing, foundation. These costs are unpredictable, unavoidable, and entirely invisible when you are sitting across from a mortgage lender being shown your monthly payment. Insurance, transaction costs. When you eventually sell, roughly 6% of the sale price to a real estate agent. On a $500,000 home, $30,000 gone in a single transaction. Add it all together, and the true cost of homeownership over 30 years is often 2 to 3 times the sticker price. The renter who invests the difference between their rent and what a mortgage payment would cost consistently in a low-cost index fund will almost always accumulate more wealth than the homeowner over the same period. This is not a radical claim. It is math. But why would an entire economic system be built around encouraging homeownership if it is such a poor investment? The answer requires understanding who benefits. When you take out a 30-year mortgage, the bank collects $278,000 in interest. This is not a side effect. It is the point. The 30-year mortgage was specifically designed to maximize total interest paid while keeping monthly payments low enough to feel affordable. The longer the loan term, the more interest the bank collects. The real estate industry collects 6% every time a property changes hands. The government collects property taxes every year and benefits from the political stability of a population too financially anchored to their home to take significant risk. The working class gets the mortgage payment, the maintenance costs, the property taxes, the illusion of wealth, and 30 years of being unable to move freely. This is not a conspiracy. It is a system, and it persists not because information is hidden, but because the mythology is so powerful, so emotionally resonant, so deeply embedded in what it means to succeed, that almost nobody questions it. Here is where it gets personal. When you imagine owning a home, what do you actually feel? For most people, the feeling is not primarily financial. It is safety, permanence, belonging, the sense that you have arrived, that you have built something real, that you have a place in the world that cannot be taken from you. These feelings are real. They matter, and the industry that profits from homeownership understands them perfectly. The 30-year mortgage was not just a financial product. It was an emotional product. It sold identity. It sold stability. It sold the feeling of having done the right for your family, for your future, for the version of yourself you wanted to become. This is why the mathematics never quite land. Because when someone tells you that your house is a mediocre investment, you are not hearing a financial argument. You are hearing an attack on something that carries enormous emotional weight. Warren Buffett, who has lived in the same modest house in Omaha since 1958, a house he bought for $31,000 and has never upgraded despite accumulating over $100 billion, has said that his house is among the worst investments he ever made. Not because it lost money, because the same capital, deployed differently, would have compounded into something extraordinary. He does not say this to be provocative. He says it because it is true. So what do you actually do? Because knowing the myth is broken is not the same as having a path forward. Here is what the evidence supports. Not ideology, not contrarianism, but the actual financial data on what builds working-class wealth across decades. The first is to separate the housing decision from the investment decision entirely. If you want a stable place to live, that is a lifestyle decision. Make it, but do not confuse it with an investment strategy. A home is consumption, like a car, like furniture, that happens to hold most of its value. Treating it as your primary wealth-building vehicle is the mistake. The second is to understand your true break-even horizon before you buy. The commonly cited figure is 5 years. The honest figure, when you account for all transaction costs and carrying costs, is closer to 7 to 10 years in most markets. If there is any reasonable chance you will move before that horizon, renting and investing the difference is almost certainly the better financial choice. The third is to size down aggressively. The single most common financial mistake homebuyers make is buying more house than they need because the bank approved them for it. Approval is not a recommendation. The bank approved you for the maximum amount it believes you can repay while still generating maximum interest for them. That number has nothing to do with what is optimal for your wealth. The smaller the mortgage, the less interest you pay, the more capital you free up for assets that actually compound. The fourth is to treat extra mortgage payments as a guaranteed return. Every dollar you pay down on your mortgage early saves you that dollar plus all the interest it would have generated for the bank. Effectively a guaranteed, risk-free return equal to your interest rate. In an environment where your mortgage rate is 6%, paying it down early is a guaranteed 6% return. For conservative investors, this is extraordinarily attractive. The fifth, and this is the one almost nobody talks about, is to take the rent versus buy calculation seriously every single time, in every market at every price point. Not as a rhetorical exercise, as an actual spreadsheet. Plug in the real numbers, the down payment invested alternatively, the monthly cost difference invested alternatively, the realistic appreciation rate for your specific market, the full carrying costs. Run the numbers for your actual expected tenure in the property. What you find will often be more nuanced than either the mythology of homeownership or the blanket argument against it, and far more useful than either. The sixth is to understand that geographic flexibility is an asset. Renters can move toward opportunity, toward better jobs, better markets, lower cost of living with almost no friction. Homeowners cannot. In an economy where the premium on mobility is increasing, not decreasing, the ability to move freely is a financial advantage that rarely shows up in any comparison of rent versus buy. None of this means you should never buy a home. The argument is not that simple. There are circumstances in which buying makes genuine sense. If you plan to stay for 10 years or more. If you buy at a moment when prices are low relative to rents. If you have a fixed-rate mortgage and inflation rises significantly. If the non-financial considerations, stability, customization, community genuinely matter enough to you to justify the premium. The argument is that homeownership has been systematically oversold as an investment, as the cornerstone of working-class wealth building, when the evidence shows it is nothing of the kind for most families in most circumstances. The argument is that you deserve to make this decision with clear eyes, without the mythology, without the emotional pressure of a culture that defines success as owning and failure as renting, as a financial calculation, honest, complete, and yours. The system that sold you the myth of homeownership did not do so because it cared about your financial future. It did so because your mortgage payment, your property taxes, your maintenance costs, and your transaction fees are someone else's revenue. That is not cynicism. That is how markets work. Every financial product was designed to generate profit for someone. The question is never whether it benefits its seller. The question is whether it benefits you, and by how much compared to everything else you could do with that capital. For the working class, in the economy as it actually exists, the honest answer is usually less than you were told. Often far less. This is not your fault. You followed the script. The script that your parents followed. The script written by people who profited from your compliance. The script can be rewritten, but only by people willing to do the math, feel the discomfort of having their deepest assumptions challenged, and make decisions based on what is actually true. That willingness to see clearly, to think independently, to choose what is actually best rather than what you have always been told, is not just a financial skill. It is the most valuable thing you can develop. And it starts with the question the entire system was built to prevent you from asking. Is this actually the best thing I can do with my money? For most working-class families, in most markets at most moments in history, the honest answer has always been the same. No.